on track to hit $1 million in the next 4 years. So in this video today, I'm gonna be showing you the exact system I'll be using and more importantly, how you can copy it as well. Now to keep this simple and repeatable, I've boiled it down to just 3 rules that I have to follow. And if you wanna build your own system, these are the rules that you wanna stick to. Number 1, I can only buy index funds, no individual companies allowed. Number 2, I have to invest every single month. There's no exceptions to this rule. And number 3, I'll let AI track everything because doing it manually is honestly just a waste of time. But here's the thing. One of these rules is one that I've struggled with for a very long time. And later in this video, I'll walk you through how breaking it can completely derail your plan to hit $1 million. Let's go. Let's start with how I make money in the first place. So here is my $1 million plan. We're gonna start with my income and then we'll talk about my wife's income. So first of all, my 9 to 5 is a data analyst. I have a side hustle as a data consultant. And then lastly, I'm a creator. This is recently monetized, so I'm not really getting paid that much from YouTube, but it's a good start. And then my wife's income, she has a 9 to 5 as well as an admin. And then she is also doing personal training. Now we need a picture of how much I've saved and invested so far so we can tell how long it's gonna take to hit $1 million. And technically we're not at 0 right now. We started in May of 2020 when we got married. That was when we started with absolutely $0 whatsoever. And after 5.5 years, we've gotten up to about $425,000 total between our savings and our investments. Most of that is in investments. So to figure out how long it's gonna take to hit $1 million, I'll show you with a very simple example here about saving your first million. Now, this one is assuming a $10,000 per year contribution and you're earning a 7% interest, which is the long-term real rate of return of the US stock market. And for our sake, we're actually sitting right about here, which is pretty close to year 21. Now, typically from a number standpoint, you would think that 500,000 is halfway to $1 million. Technically it is, but in terms of timing and compounding, it's actually not halfway. And we can see right here, the halfway mark is really around 250,000. This is the 15-year mark out of 30 years when you're using this example. So for us being at 425K, we're almost around the 2/3 mark. We're a little bit behind, but if we got here in about 5.5 years and we're investing about 8,000 per month, I'm gonna assume the long-term nominal return of the stock market because even though $1 million in purchasing power won't be the same later on, it's still gonna be technically $1 million. So I'm just gonna keep it simple. This is what we're doing right now, investing about 8,000 a month between all of our accounts. And I'm gonna assume a 10% rate of return. Could be a little bit more if we have good years in the market, could be less, but let's just stick with that. Now, in terms of the vehicle that we're actually going to use to get to $1 million, we need to answer the question, why index funds? First off, index funds and specifically ETFs are what I'm gonna be buying. These are very low cost and very, very affordable in terms of the fees that they charge for you. So for example, if you want a very low index fund that tracks the S&P 500, you can use SPLG, which has an expense ratio of just 0.02%. Meaning if you invest $10,000, your fees are only gonna be $2. And that's important to remember because over the course of like 30 or 40 years, high fees can cost you way more than you can possibly realize. And I think this is tricky and important to understand when it comes to investing because we think of a fee like 1% as being really small. Like for example, if your mortgage rate was 1%, that's a very low mortgage rate. Basically nobody has that. Or if your credit card charged you 1% interest instead of 29, super, super low, right? So you would think investing is similar, but that's actually not the case. And I'll show you with another example. So if we had 2 people, Bob and Jane, nobody's named Bob and Jane, but let's just use that. Let's say they each started with $10,000 invested. They each earned 8% and then they added 500 every month. But Bob's fee, he bought a low cost index fund that he had to pay 0.04%. Jane, however, her fee was 1%. After 30 years, how much do you think each of them are gonna pay in fees? The answer is that Jane is gonna pay way more than Bob. Check this out. So Bob pays about $6,700 in fees total for 30 years. Really, really small, that's great. Jane, however, she's gonna pay about $150,000 just for having a way higher fee. These things could be tracking the same thing. Let's say their performance is exactly the same, but because Bob is paying 0.04% and Jane is paying 1%, she pays a significant amount more for essentially doing nothing. So please, if you do not hear anything else in this entire video, if you are trying to get to financial freedom and you're buying funds that charge a lot of fees, it can really take a huge chunk out of your money later on in life because those fees compound just like your investments do. Another reason index funds are great is because of time and effort, meaning you don't have to spend time picking stocks or researching companies for months on end. You can just buy an index fund that's well diversified and you get it built in already. Index funds also have the benefit of being very easy to automate. Most brokerages allow you to do this. I use Fidelity. They have a very easy interface where you can look up something called recurring investments and just set it and forget it. And the beauty of doing that is that all of your investments start working in the background of your life and you almost never have to touch any of them. And I think the best way to do it, and the way that I'm planning on doing this, is by using something called dollar cost averaging. Now, a simple way to illustrate this is, let's say you have a stock chart that looks like this. If you're dollar cost averaging, you're buying right here, you're buying here, you're buying at the top, you're buying at the bottom, you're buying at the bottom again, maybe you're buying here, and then your average cost kind of looks like this over time. And the reason this is important is because it's really hard to time the market, and it's, in fact, I would almost argue that it's impossible. And if you were to try to put all your money in at one time, maybe you accidentally put it up here at the top, which is gonna be more expensive than if you were just to buy like every 2 weeks when you get a paycheck, for example. It also protects you from getting scared and selling down at the bottom when the market has dips. On average, the market is gonna dip every couple years. And so if you're trying to time the market and buy stuff yourself manually, you might get caught selling at the bottom, which Uncle Howard Marks says is a cardinal sin in investing, and we do not upset Uncle Howard. Now, as far as my investments go, I have 6 different investment accounts for our household total. I have my 401k, my Roth IRA, I have a taxable brokerage account, I have a health savings account, and then my wife has her 401k and she has her Roth IRA as well. My 401k, our HSA, her 401k, and her IRA, all of these are invested only in index funds. So I need to make a couple adjustments to my Roth IRA and my taxable brokerage account to make sure that I follow the rules for this challenge. This is what I was talking about earlier when I said that I'll be breaking rule number 1, and I'll show you what I mean in my Roth IRA first. So here's what it looks like. So right now, my Roth IRA has Berkshire Hathaway. I have an India ETF. I'm very bullish on India as a country. I have Celsius, the energy drink company. I have SCHD, that's for a dividend fund. I have QQQM for some technology exposure and a little bit of growth. I have Amazon because they destroy everybody. I have Tesla. I have SCHG, another growth fund. And then I have the Amazon of South America, Mercado Libre. So the ones that are technically breaking the rules are Berkshire Hathaway, Celsius, Amazon, Tesla, and Mercado Libre. These are all individual companies technically, and they are not counted as index funds, so they're breaking rule number 1. I'm gonna show you how I'm switching things up. So the new strategy is looking like this going forward. I'm gonna have SCHG as 25% because I am very, very much growth minded. I'm gonna have Berkshire Hathaway because Warren Buffett's the GOAT. I'm gonna keep my India fund because I think this is a very, very good 20, 30, 40-year long-term play. SCHD for some dividend balance. I want an ex-US fund because I don't think America can continue to dominate like they have the past roughly 15 years. And this year is a great reminder of that, where ex-US funds are up about 20% and the US is up about 10%. And so the more I learn about global diversification, the more I realize that this stuff's important. I have a small allocation to the lowest index fund, gold fund, that I could find just to get some access to commodities. I have digital gold, that people call it. I have a little bit of Bitcoin, but this is a Bitcoin ETF. It's not Bitcoin just purely. I just find it easier to have everything in one single fund. And then the last 2 that are breaking the rules technically are Tesla and Amazon. So the reason I said individual stocks can completely derail your plan to hit $1 million is because if these allocations are way too big, if you had like 50% in 2 companies or even more like that, and they have a couple really bad years and then you end up selling, you're locking in those losses for permanent capital loss, which is just a massive problem if your goal is to compound your money over a long term. So even though I am breaking the rules with these 2 companies and technically Berkshire Hathaway, I view Berkshire Hathaway as its own kind of mini value index fund because really it's just a holding company for a bunch of other companies. But I'm never going to allocate more money than just a couple percentage points to a very small amount of companies. And again, this is only in one single account. It's my Roth IRA. That's not even that big right now. Most of my money is in my 401ks, my wife's 401k, and my taxable brokerage account for right now. The HSA is going to continue to grow, and then I'm going to keep maxing out my Roth IRA, and then we're going to move to max out my wife's Roth IRA as well. So for my taxable brokerage account, most of the money is sitting in QQQ. I have one really crappy company called Novavax that I'm probably gonna sell. It's literally like $700 in that thing. And then I just sold, I think 400 shares of Celsius. So this one's technically gone now. So I have about 50% of it sitting in cash, the rest in QQQ and Novavax. Going forward, I think it's all just gonna be sitting in QQQ for now. I might consider going QQQM just because it's a smaller expense ratio, but who knows, we'll see what I end up doing. Now here's the part that I'm most excited about because I think it's the one that can make the greatest impact on your life through your finances, which is really cool. And it's that systems beat willpower. Now I'm gonna show you the typical money model that people use, and then I'm gonna show you the one that I've been using to hit $1 million, and it's been working for years. So here's most people's money model. Here's what it looks like. You get your paycheck, you send that money to your checking account, and then from there, you pay your bills, and then whatever's left over, you say, you know what? I've been working hard all week. I'm gonna send some money and have a little bit of fun, which is totally okay. But the problem with that is there's often nothing left over for saving or investing. And that's a big problem, because if you continue down this road and you end up just spending all of your extra money on fun money, you're gonna wait 2 weeks until you get the next paycheck. Then you're gonna spend it on bills and fun money again. And then you're gonna wait 2 weeks, and then you're gonna spend it, and then you're gonna wait 2 weeks. And you get caught in this endless cycle of making money and then spending all of it. This is often what we call lifestyle inflation, where if this is your money model, even if your paycheck goes up, you're probably gonna spend more things like get a nicer house, a nicer car, so your bills are gonna increase, your fun money might increase, and there's still no priority to save and invest. So this is where I think the Money OS comes into play, and I think it's a lot better. So it looks very similar, where you get your paycheck, but instead we're gonna split it up in a couple different ways. Number one, we're gonna send money straight to our investments. Oftentimes, if you have an employer that offers a 401k, it's gonna be that. If you don't, you can have a Roth IRA or a traditional one, very much dependent on your situation, but we want to be investing the first thing with our money. Next, you're gonna put money in a savings account. Now, ideally, this sits in a high yield savings account. Right now, you can get 4.5%. I use Wealthfront, and I'll leave my link below if you wanna check that out. But this is where we're gonna have things like our emergency fund, our sinking funds, and I even have my business money and taxes sitting in there so that while I wait to pay taxes next April, it still earns a little bit of money instead of giving it to the government where they're probably just gonna waste it. After that, my money goes into a checking account. Just like the previous money model, we're gonna pay our bills and we're gonna have some fun. Now, the reason this works so well is because we're spending a lot of our attention at first investing and saving our money. This is what we're doing. We are paying yourself first, which you may have heard people talk about before, but this is practically what it looks like. It means investing and saving well before you pay your bills and give your money away to other people, and well before you spend it on stuff that you don't need to survive. This is gonna be a lot more important to focus on initially, and then when you have leftover money, please go spend it and enjoy it. Otherwise, you're just gonna hate this whole thing. And the key ingredient to this entire operating system is automation. Now, it's very, very easy to set up automated deposits to your investment accounts, over to your savings account and your checking account. If you have direct deposit, which I think most people do these days, you can split up those to these different accounts. And that way you don't have to worry about where your money's going. You don't have to take any extra steps. It's just going straight to where it should, based on the percentages that you choose. And that's actually why it's called the Money OS, or the operating system, because it works in the background the same way the operating system of your computer works. And I like this entire system for 4 reasons. You pay yourself first. There's no willpower or discipline required. Now, discipline's great. I'm not arguing for that, but I think when it comes to this, it's way too easy to just spend money when you feel like it, or to waste it when you're feeling overly emotional, or not even that. If you're just simply not prioritizing it, money just seems to disappear. So this gets rid of that problem. It saves you tons of time because there's no manual tracking of your expenses. The reason I like this is because most people hate budgeting. Sometimes it can be fun and it's good to look at everything that you're spending to give you some guidance and insight on what's going on. But the reason this works so well, and the reason that you don't need to spend time manually tracking and budgeting, is because you've already set up the right things with your investing and your saving and your bills. And so the only thing that's left over is fun. You've taken care of all your responsibility. So now it's time to just spend that extra money. And lastly, I think this is the most important one. There's no shame or guilt when it comes to spending that fun money because the system is working on your behalf. Now, this still leaves room for rule number 3, which is letting AI track everything, because I don't want to do this stuff manually. Let me show you exactly what I mean by that. So I'm gonna do it through this new app called Nero, and they have some really, really cool features here and that I'm gonna show you. So the first thing they have, which is my favorite, I used to use this with Mint and Empower, but Mint is gone and Empower is kind of janky, to be honest. This is a net worth tracker. I think this is the most important thing for people to use because it allows you to see if you're making good choices with your money or not by telling you, hey, you're richer than you were yesterday, or that line's going down. You might want to change some things. Then they have stuff like a subscription manager where you see all your recurring payments. You have your, typical spend analysis that's really useful to see. But for our case today, we're going to use their AI to track all of my spending and see if it recommends any improvements that I can make. Can you look at my last month's spending habits and tell me where I can save more money? All right, so it's thinking here a little bit. And I think the really cool thing is that as it's thinking, it kind of breaks down what I've spent in a month and it shows me the description of what it is. And then it also says, hey, we're gonna create a personalized list of suggestions to help you save more money based on your last month's spending habits. So here's the best part. It gives me suggestions to save more money. I can optimize any type of recurring bills, maybe try to lower my interest rate once I get a chance to do that. I can look at my electricity bill and maybe be a little bit more careful with turning off lights or maybe changing the light bulbs. That's interesting. I can ask my internet provider if they can give me more of a discount instead of 80 bucks a month. So it just goes through a bunch of different options that I can use to save more money. And then it even gives me a timeline here of when I can implement that and say, hey, in 4 weeks, you could be saving like $300 to $500 per month if you do this stuff, which will only help me reach my goal of hitting $1 million that much faster. And my absolutely favorite part about Nero, which is why I'm telling you guys about it, is that it's actually free forever. I wouldn't recommend any type of product if I didn't use it personally and if I didn't actually like it. And I've never paid for a budget tracker or anything like that. This thing is way better than anything I've used before, and it's free forever. So I'll leave my referral link in the description for you to try out Nero for free, and then see if AI can actually help you save $300 to $500 like it might be saving me now. So that's my plan to hit $1 million in the next 4 years, and I'm gonna be documenting every step along the way. And if you wanna see my net worth when I started YouTube a year ago, check out this video next. Done.